Good morning, everybody. This is the Live Market Open for December 31st, 2015, the last day of the year, the last show. We're back from vacation. I hope everybody's doing well. I'm Yohay Elam, Forex Question Market Movers podcast, doing the show as usual for FX Street. As usual, we'll cover recent developments in markets, charts and levels, the next less than 24 hours until the next year, until markets freeze. And of course, your questions. At the end, we'll also talk about what's expecting us next week. Anyway, please, if you can't see the chat box under the video, please go to the address here on the screen, tlk.io/fxstreet-forex-live-video. Okay, so what did we have recently? Let's first talk about some currency movements in the past 2 weeks. The last show was on December 21st, just after those elections in Spain, and the week before Christmas. Well, already after the Christmas holidays. I hope that everybody that celebrated had a good time. Anyway, we did see some movements in markets, basically a weaker US dollar. This was mostly last week, and this week we have some kind of correction. The movements are not that strong, okay? But in general, the euro strengthened a bit more, got closer to 110, dollar yen got closer to 120. We'll talk about all the currencies with the charts, and we had a weaker pound and a weaker US dollar. More weakness, and more important one, perhaps for next year, came from emerging markets. The Chinese yuan weakened. Every day, the Chinese authorities set dollar yuan at a higher level, which means a weaker Chinese currency. The Russian ruble that was hurt last year because of the tumbling oil prices, and also this year, of course, is setting new lows against the US dollar, which means even lower levels against the euro. Okay, and let's look at a bit of the charts. So this is euro dollar. As you can see in the last few weeks, not that extreme movements. We had to find support here. Around the Fed at 108, then went up to closer to 110, dipped a bit around 109, then it went above closer to the high range, closer to 110 once again, and now it's sort of at the lower range of this all in all not so high range. 109.32, some support at 108.80, resistance 110, 110.70, support 108. 107.60. All in all, quite narrow ranges. We didn't have, in terms of developments in the Eurozone, we didn't have too much going on. What we did have is, the stalemate in Spain, where now elections were held on December 20th, where 11 days after the elections, we had the speech from the king, we had political meetings, but no new government. It's very unclear what will happen there. They're here. I'm sitting in Barcelona. Anyway, this uncertainty will continue with us for a few more weeks at least. Perhaps we'll have here new elections. Okay, but so far the impact on the euro is minimal. Okay, a currency that did weaken against the US dollar is the British pound. Okay, why did we have the British pound weaken against the US dollar? That's because GDP in the UK was downgraded to 0.4. Now, GDP revisions in the UK are usually very minor or non-existent, but this time we had a downgrade from 0.5 to 0.4. That sort of added pressure to the pound. We had it dip below 148. 148 still works as support, but it's sort of, I see the recent rises here as a dead cat bounce in pound dollar. Anyway, support at 148. And resistance 148.50. Also here in our range, but all in all, the pound is sort of one of the weaker links. Okay, dollar yen, we had it. It didn't dip below 120. Currently 120.38. It's hovering above 120.30. All in all, the yen has strengthened a bit. This goes hand in hand with the weaker emerging markets, sort of risk off. But if you then look at commodity currencies, you don't see that. So I think it's also developments in Japan that we had before the holidays that were sort of positive for the Japanese economy, positive for the yen, and no new action on the horizon. One of these things was the action from the Bank of Japan, which was very minimal and was seen by many as a substitute for bigger action. Okay, so if the Bank of Japan just does only a little bit, it won't do a lot. That means no more easing, no more weaker yen. Okay, Canadian dollar, one of the weaker currencies, but during the holidays it managed to stabilize, even strengthen a bit against the US dollar, 138.86, 140, the very round number is resistance, some support at 137.87, and we mentioned before Christmas, and the pair is beginning to find a range. We said before the holidays that we don't really have a real range here. We don't have real resistance because the sky's the limit. Now finally some stabilization here, mostly thanks to the holidays, because the price of oil, at least WTI, has stabilized around 36. Okay, we already dipped to 34.30 here, and they rose to resistance 37.73, which was the low in August. Now we're back to lower ground, but all in all, some stability in oil prices, 36.62. It's important to note that Brent crude also, it did follow, and now Brent crude and WTI are more or less at the same level. Okay, so we did have a weakening of Brent, which is less relevant for the loonie, but in any case, oil prices are still under pressure. Inventories are rising, but prices did stabilize during the holidays, as markets in general did stabilize. Okay, Aussie dollar. Well, we talked many times in the show about the 72.80 line. So the pair managed to break above this line and sit a bit above it, but nothing really earth-shattering. 73.60 is the next line of resistance, followed by 74, support 72.80, further support 72.20. This weakening of the Chinese yuan can be analyzed in two ways. One, the Chinese authorities are trying to weaken the yuan to support export, to support more growth, and that's good for the Australian economy. More Chinese growth, more demand for Australian commodities. On the other hand, you could see this as a sign of panic. They want to make a transition from export-based, investment-based to internal consumption, and they're beginning to give up on that. And that's not good for Australia, because if China is not doing well and is panicking, it's not good for Australian commodities. At the moment, as I said, markets, this weakening of the Chinese yuan, which is a bit more dramatic, is not seen in dramatic moves in the Australian dollar, which is very stable. Something that is more clear to explain is the New Zealand dollar. We've seen it strengthen quite a bit before the holidays, and it's just extending its range, and for good reasons. The prices of milk are going up. The RBNZ is not expected to cut. The situation in New Zealand in general looks good. New Zealand dollar weathered the Fed rate hike quite well. All in all, things look good in New Zealand, and we've seen the pair extend the range. 69 cents is resistance, support at I would say 67.90, currently 68.50, quite stable. Okay. Dollar Swiss, basically, of course, looking at a sort of inverse of euro dollar because of the intervention of the Swiss National Bank in to weaken the Swiss franc against the euro. Anyway, we're seeing the pair under 99, 99, 98, 90, support here at 98.50, I would say. But anyway, we should, when we're talking about the Swiss franc, we should look a bit more to the euro Swiss, because that's where the Swiss National Bank intervenes. So we're seeing it sort of defend the 107.60 line in euro Swiss, the Swiss National Bank, 108.06 usually almost every morning in the show. In recent months, euro Swiss has been at the 108 handle. Anyway, that's where we are now. And 108, 109, or 108.70 is resistance. Remember, there's intervention. Something interesting from Switzerland recently. There's this petition by lots of citizens calling for limiting the amount that commercial banks can lend out to the economy. That they won't. Currently, they're allowed to hold something like 10%. they're, required to hold at least 10%, and they can lend out all the rest. And if, let's say, someone deposits, the bank has deposits worth 1,000 francs, then they're allowed to keep, they can multiply the money, fractional reserve lending, and this suggestion, which will reach some kind of referendum probably, is meant to limit the banks, to allow them to lend only what they have. Okay, so let's see how this develops. It could be an earthquake, an atomic bomb, some described it. I don't think it'll pass, but it's interesting to watch how this will impact other places as well. Anyway, let's go back to currency. Well, the weakening of the British pound and the strengthening or stability of the euro led to higher moves in euro pound. Quite a move higher up there. So 73.68. During the holidays, we made a break above 73. Resistance, these lines are a bit old, I would say is around here. 74.12 and support at 73.30. Also here, the ranges are beginning to narrow, so movements are limited. Euro yen, well, above support here at 131.50. We had a dip below 130 all the way to 129.75 before the holidays early in the month, and resistance 134.20. Okay, and one of your favorites, pound yen, it broke below 180 and extended the falls. 178.47 is the current level. We had even lower levels here. You can many of the lines we've seen in the past are shattered. We're at much lower levels. Support here at 178. Okay, some sort of resistance at 179, which is also a round number. Okay, and of course 180 could still be a battle line. So the round numbers play a role in pound yen. To the downside, well, we're back to levels. Basically, pound yen is back to levels last seen right here in April. Okay, so this is quite a move during the holiday season. All right, further support, I can see it only at 175.15. That's quite far away. So this is one of the currency pairs that moved a lot during the holiday season, contrary to major pairs. Okay, so I think we've covered lots of pairs. It seems a bit quiet here in the room. Anyway, we have things to talk about also for next week. If anybody pops along and has any questions, we're right here. Okay, so let's talk about the agenda. Well, talk about a few events. Let's see what we had during the holidays. We had US GDP, the final GDP for Q3 come out at 2% within expectations. Originally, we had 1.5, then it was upgraded to 2.1, and the expectations were for a downgrade to 1.9. It was eventually 2%, more or less in line with a US growth seen in recent years, between 2 and 2.5%. This mediocre growth or steady growth, and depends how you want to see it. Anyway, what came out within expectations, more of the same is expected for 2016. Okay, GDP in the UK was downgraded. We mentioned that hurt the pound. We've seen how it moved the pound weak against down against the US dollar, and even more so against the euro and the yen. Other figures from the US, durable goods orders, no surprises there. The core was a bit under expectations, came out below expectations, and the headline above more, but nothing huge. Core PC price index as expected. New home sales did disappoint with 490,000, but on the other hand, consumer confidence did beat with 96.5 points, and that's a figure for December, so it implies accelerated Christmas shopping for consumers or just low oil prices. Okay, so the price of the pump, gasoline in the United States, is becoming cheaper and cheaper, and this leaves more money in the pockets of Americans, especially if they're traveling by car a lot to see their families. So this is a bit positive, but all in all the figures are basically balanced. Okay, Today we have very, very thin liquidity. Some markets are already on vacation. Some have a vacation today, and of course Asia is already, I think it's already getting closer to midnight over there in Sydney. We have jobless claims in the United States at 1:30 GMT. Didn't even look at the numbers. I don't think it'll have a big effect because that's the old version of the site. Anyway, we have also the Chicago PMI at 1:45. Okay. Let's look at the numbers we're expecting this week. Where did that escape? Here we go. Yeah, initial jobless claims are expected to rise from 267 to 270. Basically, no change. And the Chicago PMI expected to drop or not rise from 48.7 to 49.8. This is the FX Street calendar on Forex Crunch. Okay. Anyway, and tomorrow markets are basically closed, and I assume some of you will be recovering from the New Year's Eve party. Anyway, but China is active and they released the manufacturing PMI. This could impact the open on Monday. Okay. Next week we'll do a preview of next week at the end of the show, so we won't talk now about next week. Let's talk a bit about the trends that we had in 2015 and what people are talking for 2016. So if you look at 2015, it was certainly the year of the dollar. So if we had some weakening of the US dollar in recent weeks, this doesn't tell the whole story. For euro dollar, it began with a big fall at the beginning, and then we had some recovery. Okay, so we had a fall from around 120 to 105, and then all the way to 117, and now back down and then up. Basically, euro dollar is down on the year. Okay, because more of the QE program in the Eurozone, which began in January and was sort of expanded this month in December, and of course ongoing weakness in the Eurozone, and of course the strengthening of the US dollar towards the rate hike that did happen last 2 weeks ago, exactly 2 weeks ago. Pound dollar, it had its nice moments during the year when it did rise to higher ground and got closer to 160, 158, but towards the end of the year, it showed us a lot of weakness. Not much changed, but a bit weaker. Dollar yen was relatively stable during 2015. It did make its way all the way to 125.88, and now it's lower. Dollar CAD was one of the huge movers of 2015, especially in recent weeks. It marked this 134.60 in September and then made this correction, but then continued even higher. It's hard to remember, but early in the year, we traded around 120, okay? The big fall, of course, began already in 2014 with oil prices, but back in, Aussie dollar. Aussie dollar also weakened. Well, in recent weeks, it's showing some kind of resilience, okay? Because the Australian economy is doing well. The RBA is not in any rush to cut. So we've already reached the 68 handle, now we're at 73. But it's important to remember that earlier in the year, we all had already traded, above the 80 line. So also the US dollar was king also against the Aussie dollar. New Zealand dollar, also, it's recovering in recent weeks. It may have found the bottom here in September, but also here began the year at much higher ground. Got even close to parity with the Aussie dollar, was above 75. So quite a lot of movements in 2015. The big question is, okay, we had a stronger dollar, especially at the beginning of the year, and now things have changed. When the Fed rate hike became a reality, or towards the fact that the Fed rate hike became reality, I think from September, when the Fed did not raise rates and waited for another 3 months, we had some change in course. Okay, we had some people talking about buying the rumor, sell the fact. Okay, the Fed will hike, but it was so well telegraphed, so well communicated that now we're going to see a reverse. This is also based on history. In the past, when the Fed began these tightening cycles, the dollar weakened. One of the reasons is that, well, buy the rumor, sell the fact, but once the uncertainty is gone, once we have a clear path, the dollar can begin weakening it. We have other things, but I don't think it's already the case, because we don't know how much the Fed is going to. This isn't a classic tightening cycle. We don't know how much the Fed is going to tighten in 2016. According to the dot plot by the Fed, we're expecting 4 rate hikes. Okay, so currently it's a range between 0.25 and 0.50. Or the effective rate that is published every day by the New York Fed is 0.36, 37. So it's expected to rise 1 percentage point, 1% higher. So 136 at the end of next year, 4 rate hikes. We have 8 meetings. That means every other meeting, perhaps every meeting with the press conference, March, June, September, and December. But many, including myself, are not so sure we're going to get all of that. Some expect the Fed to reverse course after just in 1 more rate hike. I think we'll have 2 or 3 rate hikes. The Fed wants to be ahead of the curve. And if we do have, a good non-farm payrolls next week and the hint of another rate hike in March coming already in January, the markets might begin believing that we'll have all these 4 rate hikes. And the dollar, I believe, could still strengthen in the first quarter, okay, against all currencies, okay? And perhaps also in the second quarter. Then afterwards, we could have a change. Then we could have a much more bigger impact of the rate hike on the US economy, and we could have some weakening, some improvement in the Eurozone, for example, because a weaker euro, it already helps a bit the Eurozone economy. It also lifts inflation a bit. It also makes money more accessible. I think I mentioned this a few times. It's much easier now to take loans in Spanish banks, for example, than it used to be a year ago. And when we have some kind of recovery, we'll also have recovery in the currency. In the euro, for example, also the yen, the Bank of Japan is not expected to ease. The big unknowns for me are not the developed economies, but the developing economies, emerging markets, or big markets like China. China slowed down, but how deep is it? Will they make the transition or not? I think they will be able to pull it off, but it'll be hard. India is now growing strongly, but will this continue? Russia, will more weakness in oil prices lead to action? In general, oil prices are expected to remain low. There are good reasons for that. All the countries, nobody seems to cooperate with anybody. Not within OPEC. Saudi Arabia and Iran are in conflict. Iran is expected to begin pumping new oil after the sanctions are lifted, basically next week or in the next few weeks in January. So there are conflicts over there. Russia doesn't want to stop pumping. It needs the income. And the same goes for quite a few other countries. And perhaps the most important factor is what's going on in the United States. Okay? In the United States, we have one of the reasons for the fall in oil prices is the US shale industry. These new technologies, which were developed during very high oil prices, these allowed pumping new oil that was earlier inaccessible, and this sort of added to demand, to supply in markets. And with no higher demand, with sluggish global growth, this weighed on oil prices, and nobody cut production afterwards. Now, some of this pumping in the United States, some of this production has gone down, but contrary to traditional oil fields, these oil rigs can be easily shut down and turned up once again. So once oil prices begin rising, we'll have more production in the United States. Weaker prices. If prices fall too much, we could have them shut down again. So this flexibility means that any rise in oil prices because of production cuts, because of higher demand, and we could see higher demand because of lower prices, right? will probably be depressed by more production in the United States. So we could see this have an effect on Russia. Weaker Russian ruble already in recent weeks breaking the highs seen last year. This could impact the Russian economy, impact geopolitical movements by Vladimir Putin and his colleagues. We could also have Saudi Arabia, which has raised the price of gasoline for its citizens. It's still highly subsidized, but it's now a bit higher than it used to be. And we have a peg of the Saudi riyal to the US dollar. You could see things move over there. Remember, it's not exactly a democratic regime, and things could change over there, and this could have a bigger impact on the world. So I think oil prices, emerging markets will be a very interesting story in 2016. We'll talk a bit more about 2016 next week. We'll do a more organized preview, but as we don't have too much to talk about today, and for those of you watching, this is sort of a sneak preview. Okay. Let's go back, talk about the Fed a bit more, because that was the last big event of 2015, and it'll have a lot of impact on 2016. Oh, we have a question from Horace. Well, how about CAD? Canadian dollar has had a terrible year. It's actually not only oil prices. The biggest mover has been oil prices. We've seen the Canadian dollar weaken with oil prices and not strengthen that much when oil prices recovered, okay? So we've seen sort of an inherent weakness in the loonie. What else? We have the Bank of Canada in December saying that the lower bound for interest rates is not zero. Lower bound is minus 0.50. Currently, the interest rate in Canada is plus 0.50. Okay, so they're not expected to cut rates anytime soon, officially, yeah? But they sort of opened the door to deeper cuts. Yeah. In addition, employment situation in Canada is sort of mixed. It's not really improving. It puzzles the central bank, puzzles the government. What else? Other figures such as trade balance and other economic indicators weren't that good. So it's not only the weakness of oil prices. Eventually, a lower Canadian dollar will make Canadian goods more attractive to the biggest market, to the United States, and in general to the world. And we could have the Canadian economy improving, not necessarily in oil prices. Also in Canada, there are some worries about elevated house prices in Vancouver and Toronto. Let's see how that plays out. The central bank tries to diffuse this bubble before it bursts. Some say it's not a bubble, of course. You never know if it's a bubble until it bursts. So, yeah, I hope this answered the question. In terms of lines, dollar CAD currently 138.86, support 137.87, resistance 140. But if oil prices continue tumbling down, 140 will be toast. Of course, it's not. It's a round number, and we had the pair sort of retreat after making an attempt to break higher. Talking about dollar CAD, but nothing. But the sky's still the limit in dollar CAD if oil prices dig the bottom of the barrel. Okay. Hope this answers the question. Let's talk a bit about the Fed. In the United States on December 16th, if I'm not mistaken, yeah, we had the historic rate hike, the first rate hike since 2006, okay? Nearly 10 years. And the first change in interest rates since 2009. Or, sorry, since late 2008, since the financial crisis. The surprising thing in the hawkish part of it was there was no change in the final rate for 2016, the dot plot. I mentioned this before. 1.4%, that means 4 more rate hikes, okay? It's the median forecast, okay? there is, among the other forecasts, we had slightly higher forecast for growth, slightly lower for inflation, and also for employment, but no big changes. There were no dissenters. That means Janet Yellen pulled this off with 100% support. Next year, in 2016, which is just a few hours away, we're expecting the composition of the Fed members changes. Okay, what does this mean? It means that we're going to have more hawks in the Federal Reserve. That means we could have a higher chance of rate hikes. Talk about that, of course, when we talk about 2016 more in detail next week. Anyway, the immediate reaction was a stronger US dollar, then a retreat, and then another strengthening. Since then, we had a weakening over the holidays. Here are some comments from Yellen that we heard in that meeting. She was asked this simple question: why did you raise interest rates? And the answer was, we don't want to have to raise rates abruptly. Okay, the Fed wants to be ahead of the curve, because if the economy continues warming up, heating, and you could have higher inflation, and then the Federal Reserve would have to move too fast, too sharply, and perhaps trigger a recession. She also provided hawkish words regarding inflation. The current low inflation, of course, it's close to zero because of oil prices, is transitory. This is different from the European approach, from the ECB's approach, which says that they fear that weaker energy prices will feed into other prices. Okay, in the United States, they don't think this is the case. Of course, one of the big differences is that in the Eurozone, we have unemployment at, I think, 10.7 or 10.8%, close to 11%. In the United States, it's only 5%. Basically, a strong economy in the United States, a weak economy in the Eurozone. That's why deflation is less of a fear in the United States. No need to see inflation reach 2% before moving again. Okay, they don't. Of course, if inflation falls too much, they might pause or even reverse. But if we have stable inflation numbers, they could move again. Probably not in January. The chances are very low. But in March, all the options are on the table. In general, she also said, with all these rate hikes, monetary policy is still loose. We're still have an accommodative policy, still supporting the economy, still helping out. So no extreme moves over there. Okay. Yeah. So that's the Federal Reserve that we had. Let's talk about another event we had earlier in December. The ECB, what the ECB decided, this is the damage control he did, because the ECB decided to leave the QE program unchanged at 60 billion per month, but reinvest the proceeds. Okay, so this is what the Fed does anyway. Even now, after it stopped QE, for every bond that matures, the ECB, the Fed buys another one. The ECB announced that it'll do this, and they also extended QE from September 2016 to March 2017. Draghi, the markets reacted with disappointment to this. Why? Because they expected more printing, more QE immediately, from 60 billion to 70 or 80 billion. 75 was the average. Okay. Draghi explained that later on. It was already 3 weeks ago. Okay, but this is still relevant. That both actions, even though we didn't have a monthly enlargement of QE, we did have these moves are worth $680 billion euros. According to my simple math, that means that the reinvestment of proceeds is worth another 20 billion per month. Markets didn't really buy that because they expected him to do more, and they were disappointed. His credibility was hurt. Anyway, he said also he's ready to do more, and he admitted he's disappointed with the market reaction. The ECB doesn't meet early in January. It meets in the middle of January, closer to the end. This year, this time in January, we had the QE program announced. This time, no new policies on the agenda, but maybe hints of more action in March are expected. Okay. So these are the big events that we had in December. We had lots of action around that. The ECB did more damage or more action. Euro dollar jumped from it dropped nearly to 105.20, and then you can see this one-day move here, one of the biggest moves in many years, the biggest move since 2009. This rise from all the way from the bottom here to here, from 105.20 to 109.80. Then we had it fall a bit, stabilize, rise a bit higher. Anyway, this is the Draghi disappointment. We had action also around the Fed, but Draghi's the bigger surprise came from Draghi. The Fed made it clear that everybody knew what was going on. Okay. Any more questions? Anyway, we're seeing euro dollar weaken this morning here in the old continent. As I said, some banks, I think Barclays and others, said that they expect year of end movements to support the US dollar. What are your end of year movements? The final value of currencies, of stocks, is later sent to people who are with mutual funds and things like that, and owners and participants in mutual funds, all kinds of investment vehicles. The managers are committed to some kind of levels of bonds, stocks, currencies. So there are always adjustments towards the end of the month, more towards the end of the quarter, and of course towards the end of the year. Now, these adjustments don't happen only on the last day. They happen beforehand as well. But there is always some last minute scrambling. So we're already seeing some stronger US dollar. Again, the moves are not huge. The range for today is 20 pips, in line with the slow holiday trading. Let's see if we have last minute moves also in the US session, because we do have some releases then. And even though the releases can come out without surprises, it can still move markets. Another question, is parity still possible? Anything is possible. I think it'll be hard to reach parity. I think we could have dipped below 104.60. 104.60 was the low seen in March, and the 12-year low right here. But parity, I think, is a bit too far. I think the US dollar will strengthen early in the year and also against the euro, but I think it'll be hard for the pair to reach parity. Remember, the Eurozone still has a trade surplus. That means that if there was no speculation in markets, we would have seen the euro strengthening against the dollar, because Europe exports more than it imports. So on quiet days, we have the euro supported just by regular transactions. Of course, with weaker situation in the Eurozone, monetary easing, and on the other hand, tightening in the United States, and a stronger economy, we have a movement towards the dollar and against the euro, but it's not unlimited. Let's put it this way. Okay. This answers the question. Okay, let's begin the wrap up for today, and then we'll do a preview for next week's events. I'll take a sip of coffee. Okay. This is the wrap up for the live market open for December 31st, 2015, the last show for 2015. Recent in the holiday trading, we didn't have huge moves in major pairs, but we did see a stronger euro, a stronger yen, a stronger Kiwi, Aussie, and CAD, and a weaker pound and a weaker dollar. This means we didn't have huge movements in these pairs against the US dollar, but we did have, for instance, pound yen fall a lot, that was that is the pair that stood out most during the holiday season. We did have weakness in the Chinese yuan and the Russian ruble, emerging markets, two of the BRICS, and this could be a sign for things to come next year with weak commodity prices. According to some analysts, some banks, we're expecting some dollar strength to end the year, because of last minute adjustments. There are calculations according to portfolios and things like that. I don't expect anything huge. We are seeing a stronger dollar across the board this morning. But for instance, in euro dollar, the range is only 20 pips. We could have a wider range, but nothing huge. Okay. Today we do have a few things on the agenda. US jobless claims at 1:30 and the Chicago PMI at 2:45 times our GMT, of course. Tomorrow markets are basically closed. Don't try to trade. But if you are watching some news, we have China releasing the manufacturing PMI. All in all, we had a relatively quiet holiday season. We had the last big move of the year, or one of the most important events of the year, on December 16th, 15 days ago. And we had some echoes in the days coming afterwards. But in the last 10 days, we have very stable markets, generally weaker dollar, and then some stability. Okay. So today markets close early. I hope you will too. And enjoy the New Year's Eve parties. And we'll be here, of course, on Monday. Now, Monday, we have a new and very, very busy week. So let's begin the preview for next week. Next week, the first week of 2016 begins on January 4th, and this begins with PMIs, Purchasing Managers Indices. First comes China with the independent PMI, not the government one on Friday. It's more important. Let's see if the Chinese economy is doing well. Most important for the Aussie, but also for other currencies, because China is the second largest economy. We need a stronger China. We have the US ISM manufacturing PMI also on Monday. This is the first hint for the non-farm payrolls coming on Friday. Manufacturing in the United States has been weak. Well, all over the world, manufacturing is the weaker link, especially in the developed world. That will serve as the first hint. We have the employment component there as well. On Tuesday, we have milk prices in New Zealand. Let's see if they continue rising. And the Kiwi, which stands out as one of the strongest currencies if it can continue rising. And we have inflation numbers from the Eurozone, the preliminary numbers for December. This will be interesting to watch, and the key for the euro. And Wednesday, we have the ADP non-farm payrolls, only private payrolls, but certainly has an impact, and a big hint towards the NFP. And another big hint is the ISM non-manufacturing PMI, the services sector in the United States, the vast majority of the US economy. And on Thursday, nothing that really stands out, but quite a few events as well. And on Friday, the big event of the week, US non-farm payrolls, the last jobs report for 2015. Of course, these figures are revised, so we'll have sort of a full picture for the year. Let's see how many jobs the US economy gained for the year, and how many in December, and the unemployment rate. And of course, wages. Wages are critical. In November, we had in October, we had an excellent rise of 2.5% year over year. In December, it was a bit weaker, 2.3. That's important to watch. And we have a jobs report also in Canada. That's expected to, it's of course, the Canadian dollar is a bit vulnerable. Let's see if the job situation improves a bit over there in the cold winter. And yeah, so we have a very busy week next week. Usually the first week of the month is busy. The first week of the year is extremely busy because everybody's back from holiday. Volume is high, liquidity is high, and of course, traders are back to markets after the holidays. We'll be here every day next week. In some European countries, there's a holiday on January 6th, the Epiphany, if I'm not mistaken. This includes Spain, but don't worry. I'll be here also on Tuesday and covering the events of the day. Anyway, it's expected to be quite a busy week after a sleepy holiday season. Okay. Any last questions? Another thing to mention is that next week we'll have a deeper preview of 2016, of course, with forecasts, guesstimates, any way you want to call it. Okay. All right. I see no new questions, so Thank you everybody for coming. As usual, the show, the preview, and the wrap up will be available as videos on the FX Street website, and I'll republish them as well on Forex Crunch. So for those of you that didn't see it, or if you want to see it once again, you can see it as usual. Anyway, nice comment. Thanks. Great. Thanks. I look forward to see you, says Horace. We'll start watching your market analysis. Thank you very much. So I wish everybody a happy New Year. Don't drink too much in the New Year's Eve parties because the day after is also important. Life goes on after the party, and also trading. We don't have trading on Friday, and we have a long weekend. But Monday is a new day, a new week. Better to come a bit not overhung too much. So I wish everybody safe and successful trading day today. A very happy New Year. An excellent party tonight, and see you on Monday. So that's it for today. Thank you very much, and goodbye.